Okay, hi everyone. This is going to be the first video here for the PowerPoint. So I'm going to break this into two videos just because it kind of gets heavy at the end. I don't want to lose you on this. And there's a lot of slides, like 112 slides. All right, it's hard to do that in half hour, 45 minutes. So break it up into two videos, not a big deal here. What are we talking about in this chapter, right? So, we've said at a very simple level that you're going to credit your revenues, right? Maybe debit cash, account receivable, right? We've seen this in all of our accounting classes up until now. We said generally under GAAP accounting, right? You credit revenue whenever you earn the revenue, not necessarily when you get the cash, right? That's accrual accounting. Now, right, what we're doing is we're building upon that framework and we're saying, okay, we do this journal entry. The question then becomes how much, right? What are the numbers that we put in there if we were to quantify this? And then when, right, or what situations tell us when to recognize the revenue. It's not always obvious, right? There's a lot of variations, twists, and turns for it that we're going to see, right? So with recognizing revenue, crediting revenue, right? We have this 5-step process. They build it out a little bit further here. So we're going to say, hey, is there a contract, right? An underlying contract, offer, acceptance, consideration. You can look at that from your business law days. Then we're going to identify the performance obligations, right? What do I need to do under the contract and what do you need to do under the contract? It could be as simple as just, hey, I'll sell you the inventory, you give me the cash, right? There could be a single performance obligation in there for each of us. That could be multiple as well, right? We'll talk about that. Then we determine the transaction price, right? What is the sales price, right? Most of the time it's obvious, but there are some exceptions to that. Then if there's multiple performance obligations, we have to allocate a portion of the sales price to each of those. So what would be an example? Hey, we sell a car, right? And it comes with a year subscription for GPS on it, right? We sell the car for, $100,000. How much of that are we going to allocate to the car portion of it, right? Which we can recognize at the point of sale versus how much of that are we going to recognize to the subscription service, which we're going to recognize over a period of time, over the next 12 months as we earn it, right? We'll look at the formula for doing this, right? It involves a lot of standalone prices in there. And then accordingly, as I said, right, as you recognize the revenue, you earn it, right? It can be at a point in time or over a period in time. Most of the time, it's, like I said, it's very simple. Here's the inventory, give us the cash, there you go. It can be over a period of time, right? For the next 12 months, we're going to provide you this subscription. We'll recognize it, monthly there. Okay, there's an MCQ there. You can look at that. A couple things they say here, right? We're going to need to focus on when control has transferred, right? Here is the inventory for the sale. What are some kind of indicators or things that could tell us that control has passed, right? Well, they have an obligation to pay us. Legal title has changed. Physical possession has changed. They now have the risks and rewards of ownership. If this thing blows up, hey, it's on them. They deal with it. They've accepted the asset on it. So then they give us an example right here of some of these, and they're going to start with a point in time, right? So boom, at a point in time, we're going to recognize revenue. So they have here True Tech Industries sells Tribox, right? So it's a video game system. And it looks like the video game system includes no other goods or services. So the only thing they're selling here is the Tribox, the Xbox, right? And they're telling us some things here, right? They're selling 1,000 of them for $240 each. On December 20th, right, it looks like a store, Best Buy, orders 1,000 of them, and they promise to pay within 30 days after delivery. Well, on this point in time, right, we're not going to have a journal entry because we haven't earned that revenue yet. However, right, on January 1st, whenever we deliver those Xboxes, right, then we can make the journal entry for the sales revenue because we've earned it. Control has passed. Finally, on January 25th, when they pay us, right, that's great, we got the cash, we'll flip out the receivable. So this is really saying, hey, there was the order date, the date they made the order. There was the delivery date where we gave them the Xbox. And then there was the payment date where they gave us the money. That is where we would have the journal entry for the revenue at a point in time. Right, they give you some MCQs here you can look at. Now they're talking about recognizing revenue over a period of time, right? So here, as we earn it, as we earn it, as we earn it, as we earn it, we recognize it over that period of time. When do you do this, right? What are the criteria that tells you that you need to recognize it over a period of time? Well, essentially, if any of the following, A, B, or C, 1, 2, or 3, happens, then you're allowed to recognize it over a period of time. Specifically, the customer consumes the benefit of the seller's work as it's performed, the customer controls the asset as it's created, or the asset has no alternative use. In these situations, right, revenue is recognized in proportion to the amount of performance obligation that's been satisfied. Right, so hey, a 12-month subscription, 1 month has passed, we provided them the service, we'll recognize 1 month, 1/12 of the revenue, right? So here, right, it says True Tech Industries, they sell 1-year subscriptions. Looks like they're $60 each. How would they account for this, right? If they sold 1,000 subscriptions, we'll debit cash, credit unearned revenue or deferred revenue for 60,000. Right here, it's like when you get the money, that's not when you earn it, but as the next 12 months pass, incrementally, marginally, you earn it, right? That's what this is saying here. Hey, as time passes, every month, flip out that unearned credit, the earned revenue proportionally. All right, so it says if a performance obligation doesn't meet any of the 3 criteria for recognizing revenue over time, then you can recognize it at a point in time when the performance obligation has been completely satisfied. Usually this occurs at the end of the contract. So they talk about a simple example here. Hey, you could have a painter who's painting a house. It might take him 4 days. Could he hypothetically, right, do it 1 day at a time, credit revenue as he earns it? Sure, it's probably easier if he just waits until the end of the 4 days and credits the revenue then, right? That's kind of what it's saying there down in the parenthetical. And then they say here, okay, to recognize revenue over time, a seller needs to estimate progress towards completion, right? It's pretty easy whenever it's like 12 months and 1 month has passed, but it's not always that kind of fixed set time, right? It might be something like we're working on a long-term project. We need to look at what percentage we're done in comparison to the total amount we think it's going to take. And in this framework, right, they kind of have an output-based method that you can use to help you that says, hey, up to today, right, what is our proportion that we've transferred over to them? And then an input-based method, which again is looking at a proportionality factor there relative to the total effort needed. It's basically just saying, hey, as you earn it, there's different ways we could capture that, but it's not recognizing it up front, it's recognizing it over a period of time, incrementally. Okay, so let's say, right, we talked about that 5-step process, 1, 2, 3, 4, 5 for recognizing revenue. Say that when we look at it, there are multiple performance obligations, right? Well, right, it's not just here's the inventory for cash. It might be like we're giving you a car and we're giving you OnStar or GPS for the next 12 months, right? There's multiple things that are going on here. In this situation, right, we're going to have to modify step 2 and step 4 in that 5-step process, right? Starting with step 2, right, sellers account for promises to provide a good or service as a performance obligation if the good or service is distinct from other goods or services in the contract, right? If it's distinct, right? So it says if it's distinct, you can account for it separately. What does distinct mean? Well, it's capable of being distinct and it's separately identifiable. Let's look at an example here to show us it, right? When we talked about the car and the GPS, those are distinct. It's pretty obvious, right? Here we have that kind of Xbox example again, right? And it looks like they're selling Xboxes plus 1-year subscriptions, right? If you buy them separately, right, you can buy the subscription, like the Xbox Live, for $60, and you can buy the Xbox for $240, right? That's the standalone prices, right? If you buy them individually. However, right, Xbox says, look, we'll sell this as a package deal, right? For $250, we'll give you both, right? So how would you account for that? Because there's kind of multiple performance obligations here. You got to give them the the Xbox. You got to give them the Xbox Live, the online service for a year, right? So it's saying here, hey, right, this is going to modify step 2. There's multiple performance obligations here, right? You're giving them the Xbox in the service. Accordingly, right, what we need to do here is kind of break out and recognize the revenue as we earn it, right? We keep our worlds separate here. So in total, right, we sell the package for $250, right, where you get both. And hey, we sold 1,000 packages, right? So we get 250 grand of cash, right, from this situation, right? And when we look at it, at the individual level, it's $250, right? If you buy the package. However, right, we know that you don't recognize the revenue from all of this at the same time. And one thing, right, there's different things going on here. We kind of have to pluck out the components, right? We pluck out the Xbox and we'll recognize the revenue from that whenever we sell it. We pluck out the subscription and we'll recognize the revenue on that over a period of time as we earn it marginally. What we need to do is, right, this is the $250 is kind of the package price, but we need to break that out. Of that amount, how much goes towards the Xbox, how much goes towards the service. To figure that out, right, to break it out, you have to look at the relative standalone prices. Right, and what we do here is we say, okay, from the Xbox point of view, right, we sell it by itself for $240. We'll divide that by what we sell it by itself for plus what we sell the Live for, right? So it's like over Xbox plus Live, right? We do Xbox, right? And this is based off the standalone prices, right? We see it's 80%. Do the same thing for subscriptions, 20%. Hey, of this $250, 80% or $200 is going to be associated with the Xbox. 20% or $50 is going to be associated with the subscriptions. We did this at like a higher level sale, right? I think it said, how many did we sell here? Was it 1,000 or something? Right? Yeah, 1,000 systems. So in this way, right, whenever we make the sale, right, we're going to have, in this case, $200,000 right? Namely the 200 times 10 or times 1,000 for the X boxes, right? And then we're going to have 50,000 for the live, right? And with the X box, right, we'll recognize the revenue now at a point in time. Sorry, it's trying to draw a point there because here you go. Here's the X box. And then for the live, right, that's unearned as of right now, right? We're going to recognize that later on over a period of time, right? And that's what's going on here. As we earn the revenue from the live, we'll flip out the unearned and we'll credit the revenue. Okay, so this is just kind of showing each of those steps we went through there. They have a couple MCQs you can look at. Now we're going to build off of some specific items here, right? So we said we have 5 steps, 1, 2, 3, 4, 5. Each one of those steps has sort of some like oddities to it, some things that you got to be aware of where it's not super intuitive or common, but it could happen in real life, right? So let's look here at issues that arise with step 1, right? So step 1 of that revenue process says identify the contract. Well, essentially you have to see, do we have a contract? And how we define a contract here is for purposes of revenue recognition, right? In other words, we're looking for things like commercial substance. It's been approved, there's rights, there's payment terms. It's probable we're going to collect. There would not be a contract if basically either of the parties could terminate the contract at any point in time, right? That's called an illusory contract, right? Anybody can do whatever they want, right? Well, it's not really a contract because we're not holding anybody to anything here. And if neither the seller nor the customer has performed the obligations, right? So if it's 1 and 2. All right, let's look at an example here to kind of illustrate this. They're asking us here, like, at what point in time, for purposes of revenue recognition, sorry, I'm stumbling here, is there a contract? Right, well, it looks like they ordered some Xboxes, Best Buy, on December 20th. That's great, we made an order. Neither of the parties have performed yet, and guess what? Both of the parties can cancel at any point in time, right? It's not really a contract yet, right? Either party can do whatever they want. On January 1st, it looks like they received $250,000. I'm sorry, there was delivery, and then on January 25th, there was payment. When does this qualify as a contract? Right? Well, it's not going to be up here because there's been no performance yet, and either party can do whatever they wanted. Instead, it's going to be whenever delivery was made on January 1st. Couple other things here, right? So that was step 1, identify a contract, right? Well, there's some nuances to it. How about step 2 when we look at the performance obligation? So we looked at like sort of the first thing that could happen is if there's multiple performance obligations, and you have to look at those standalone prices for kind of allocating and plucking out the revenue we recognize now versus the revenue we recognize later over a period of time. The other thing to be aware of is some things are not performance obligations. So any kind of prepayments, right? They give us money ahead of time before we provide that. That's going to be part of the underlying thing we give them. Any sort of quality assurance warranties, that's part of the underlying thing we give them, right? There's like legal warranties, fitness for like purpose. This thing works, right? Likewise, the right of return, we'll talk about how you account for returns at a later point in time, but that's not a separate performance obligation that we would have. However, what is a separate performance obligation, right, where you'd have to, again, account for them separately here, is if there's extended warranties above, beyond the basic sort of inherent warranties, we give an extended warranty. Or alternatively, right, if we give the customer an option that basically gives them a material right, namely something the customer would not receive otherwise, and the seller is obligated to provide it. Let's look at an example here to kind of show this situation where there would be a separate performance obligation from a material right. Right, so TrueTech offers a promotional coupon with every try box it sells. The coupon gives the customer an opportunity to buy a headset that normally costs $150 for $90. Right, the coupon has to be redeemed within a year. They estimate that 80% of the customers take advantage of it. How do we account for this if we were to sell 100 Xboxes? So what's going on? That's a mouthful. Hey, we're Xbox. We sell 100 Xboxes. When they open up the box, right, there's a coupon inside, right? The coupon says, hey, you can buy a headset for $90, a 40% discount. We think of all the Xboxes we sold, right, 100 of them, that 80% of the customers are going to take us up on this coupon, right? So really what's going on here is we have two performance obligations, the Xbox and the coupon, right? First thing we need to do, right? Remember we said whenever there's multiple performance obligations, when we looked at like the Xbox and the Live, right? In order to kind of bifurcate and allocate that, we had to look at the standalone prices, what we sold it for individually. So here, when we have the coupon, we kind of have to do a similar thing. We have to look at the standalone sales price of that, right? So the coupon, the discount is $60. We think 80% of the people here are going to take us up on it. So effectively, right, we're going to say that coupon is worth $48 as a standalone price. Then what we do is we repeat the framework we did for what was going on when we sold the Xbox and the Live, right? We use the standalone prices to help us here, right? So $240 for the Xbox plus $48 for the coupon, right? $288 is kind of the total price here, right? For the two standalone items. So then we take the Xbox, what we sell it for individually, over what we sell both of those for individually, multiply it times the 240 we sell the bundle, as it were, right? The Xbox with the coupon inside, times 100, there's $20,000. Same thing for the coupon, right? What's going on here, right? We sold 24,000 in cash. Always start with cash. Of that amount, right, we're going to say 20 goes towards the Xbox, right, which we can recognize now at a point in time, and 4 is going to go towards the coupon, right, that we're going to recognize over a period of time as people kind of use those coupons. How did we, right? It's easy to look at the facts and say, okay, we sold it for 20, right? How did we break out what goes here, right? We kind of had to phone a friend, right? We looked at the standalone prices to help get us the percentage to allocate it out, right? It's just like when we looked at the Xbox Live with the Xbox, but it's a little bit different here because there's a coupon. There's a little bit more math involved on it. They got some MCQs. You can look at it. How does this work, right? If we're looking at step 3, what are kind of the concerns or things we got to be here aware of with the transaction price? Most of the time it's going to be obvious. Hey, we will sell you this for $100. We will sell it to you for $1,000. There are things we have to be aware of in this, right? Variable consideration, if they have the right to return it, if there's a principal or agent, the time value of money, and any payments by the seller to the customer. All right, so let's unpack these one by one, starting with variable consideration, right? So we're looking at step 3, the transaction price. This is basically a contingency, right? If X happens, then Y revenue will occur, right? How do you account for it, right? We're going to look at an example here. Hey, we'll give you $300 up front, and if certain criteria are satisfied in 6 months, we'll pay you $180 more, right? When there's that contingency in play, how do you account for the revenue, right? Well, they give you two methods, right? Two ways you can do it. One is the expected value, and one is the most likely amount. Basically, you're going to want to pick the one that you think has the best prediction ability. But let's look at these, right? So we're looking at a setup here, right? It looks like True Tech enters into a contract with Pro Sports Gaming to add online games, right? So you can think of it like Xbox and then Blizzard, right? If you know the Blizzard company, the one who makes like World of Warcraft, I don't know if they do Fortnite. I don't know. I don't play too many video games, but here's the deal, right? They say to us, Blizzard or the video game company, look, Xbox, we will give you upfront $300,000, and if, right, 15,000 hours are played of our game, right? We want people to buy all the add-ons and the whole little like I can't remember what they call them, but it's all these like little microtransactions where they make all their money, these companies. But if you meet certain criteria, Xbox, we're going to give you 180 grand as a bonus, and we think from Xbox's point of view, there's a 75% chance that that's going to happen, right? So what's going on here, right? Hey, Xbox, we'll give you 300 grand up front, and if you meet certain criteria, then we'll give you 180 on top of it. And Xbox thinks there's a 75% chance we're going to meet that criteria. As a starting point, right, with regard to the $300 that they give us up front, right, debit cash, credit deferred revenue, right, we'll recognize this, for the next 6 months, 50 grand a year, right, 300 divided by 6. How about, right, so that's for the 300, how about for the 180? How do we deal with the if then? Right, well, there's two options, right? There's the expected value and then the most likely amount. Let's look at option 1, the expected value. And this basically says, look, there's two outcomes. We could win the whole shooting match, right? They give us the 300 and the 180, right? There's a 75% chance that happens, 360 grand. On the flip side, right, we don't get the bonus. The only thing we get is the 300,000. There's a 25% chance that happens. Add them together, right, we're looking at 435,000 that hypothetically we would recognize over the next 6 months, kind of ratably, right? That was option 1 for the bonus, right? How about option 2 where we use this most likely amount, right? Well, this says, hey, the most likely amount is $480,000, right? So if you divide that by 6, each month for the next 6 months, we'll have 80,000 in revenue, right? But of the 480, right, the most likely amount, that's 75% chance winner, 300 divided by 6 or 50,000 is going to be the amount for the deferred revenue from, this pot up here, and 180 divided by 6 or 30,000 is going to come from the bonus, right? So we're going to build up the bonus, right? And then the deferred revenue is coming from the 300. It's kind of like the money in the bank, as it were, right? We get it up front, we recognize it. The bonus is what we care about here, right? This is the if then. We build up this receivable account every month, 30,000, right? So every month for 6 months, we do that journal entry, right? This guy right here. If at the end of that, right, we get the bonus, debit cash, get rid of the receivable that we've been teeing up for the last 6 months. If we don't receive the bonus, right, like frowny face, then we got to get rid of the bonus, right, that we've been teeing up, but we also have to flip out the revenue that we've been teeing up for the last 6 months, right? Like we've been, of this amount, 80, 50 is for the 300, but 30 comes from the bonus. So if we don't get the revenue or we don't get the bonus, then you don't get the revenue for it. You got to flip that out over there. This is just some variations on this, right? So it says assume after 3 months, right? So you were doing that journal entry for 3 months. We conclude that we're not going to get the bonus, right? Well, in that point in time, you're going to do, right, the frowny face entry, but for 3 months, right? 30 grand times 3 months. It's the same as this thing right here, except it's for a 3-month period. Right, so for the first 3 months, you did the entry, then you found out frowny face, you got rid of it. What do you do for the next 3 months? Well, you just recognize the revenue from the 300,000 piece, right? From that original journal entry that you recognized over 6 months, so 50 grand. They then have some MCQs you can look at, right? One of the things you do have to be aware of here is if facts and circumstances indicate that there's going to be a revenue reversal, then you do not account for the bonus, right? In other words, if something is objectively bad, right, if there are indicators that say no bonus, right, you're not going to get the bonus. In other words, there will be a significant revenue reversal, then you don't account for it. Stated alternatively, if it's probable that there's not going to be a significant revenue reversal, then you do account for it. So there's, some of the, specifics, the nuances. What would be those facts and circumstances that would tell you if there would be sort of that constraint on it? They give us a little example there. And then they say, oh, okay, now that we know this new rule with facts and circumstances tell you that you shouldn't account for the bonus, what would you do, right? Well, in that case, right, the 300 that you got up front, just account for that, marginally. Every month you get 50 grand, 50 grand, 50 grand. We will ignore the bonus part of it. We won't do any journal entries for that. But then they say, oh, right on April 1st, right up front, we thought it was bad, but now it's good, right? We're gonna, the facts and circumstances tell us that we're gonna get the bonus. Now, right, because it's like reasonable to expect that, right? You would continue to account for the bonus in there, right? You'd build up the receivable, the service revenue in those kind of situations, right? And here, because there would only be 3 months left, right, you would do it, you'd kind of do this little catch-up journal entry there for it. And then you would recognize it, the remainder over the remaining 3 months, right? So you get the 90 here through the catch-up entry, and then you would do 30, 30, 30. All right, a few other things, and then we're button up against time here. So right of return, how do you deal with this, right? So you sell stuff and it's possible that your customers can return that, right? What do you do? Well, essentially you're going to report your net sales revenue, right? So it'll be your gross revenue, right? So in total, we sold it for $240. We expect 5% returns, $12,000. Our net sales revenue is going to be 228. So that's the idea. We're talking about revenue, the transaction price. Yeah, you're going to have to build into that the fact that sometimes people return stuff. All right, how about principal and agent? How does this work? Right? Well, the idea with this is say we're Apple, right? And it's more like a cherry than an apple, right? But we have this new iPad that we're selling for $500. Okay. We come to you, our sales agent, right? You're an agent. We say to you, look, go over to Germany, to Europe, right? We want you to be our agent and sell this iPad. We're trying to get everybody in Europe to like iPads. How do you recognize the revenue, right, from this if you're Apple? Well, essentially what's going on here is Apple is the principal and the agent is the agent. In other words, they're providing the goods and services, and the agent is a middleman to the customer, right? They're selling it to that customer in Germany or Europe. Well, essentially, what we do here is um, Apple is going to recognize revenue whenever the sale occurs, right? It'll be the $500 that this guy sells it for. But guess what, right? He isn't doing this for free. He's going to get a 10% sales commission, right? So let me let's change this, right? So he sells it, right, for $500. So he's going to have $50 of revenue from his point of view, right? From Apple's point of view, right, they'll have $500 in revenue. They're going to back out the $50 expense, the commission they pay him. So their net will be $450, right? So that's the idea here when there's a principal and an agent. And that's what it's showing here, right? You're going to treat that expense there. The selling commission is an expense. All right, how about our friend time value of money, right? How do we deal with this, right? There's and after this, I think there's only like one more thing, and then we'll pause it because we're getting towards the end of the time here. So if the time value money is a significant part of the contract, and really what this means is we're looking at stuff here for a year plus, right? If there's a difference in time between when we get the money and there are the services or the goods, or on the flip sides, there's the services and later on the money. If that's at least 1 year, then we're going to have to consider the time value of money whenever we figure out the transaction price for purposes of step 3 of the revenue rule system here. So essentially in this situation, we're going to have two components, a delivery component, which is equal to the cash price of the good or service, and a financing component, which is equal to the interest that's considered paid if it's a prepayment, or to the seller in the case of a receivable, right? So this will make more sense when we look at the examples here. All right, so let's look at the prepayment example, right? This guy right here, what's going on? Okay, so essentially this is a prepayment, so there will be money first, and then later on there will be the goods, right? So I'm just going to draw an X box there. Right, so on January 1st, TrueText enters into a contract with GameStop to deliver 4 $240 Xbox modules that have a combined fair value of $960. Let's say that GameStop pays TrueTech $873 on January 1st, right? So that's on 1/1. And TrueTech agrees to deliver the Xboxes at the end of the year, right? So we have like a 1 year period here. How do we deal for this? Well, on 1/1, right, we're going to do this journal entry. Debit cash, 873. Credit deferred revenue. We didn't earn it yet. We didn't give them the Xboxes, 873. How do we then deal with the 12/31 journal entry? Well, because this is a year, right, we factor in the time value of money. We're going to treat it as an interest expense of $87, right? We'll get rid of the deferred hit interest expense, and then we'll recognize sales revenue for $960, which gets us up to that fair value amount, right, on it. So it's kind of like we're taking the 960 over here in revenue, we're shrinking it down whenever we get the cash up front in light of that time value of money. So that's the prepayment case. How about a receivables case? What's going on here? So this is going to be the flip side, right? There will be the Xbox up front, and then later on, there will be the cash, right? So again, it says here, same facts on January 1st, they enter into a contract to deliver 4 Xboxes that have a combined fair value of 960. More specifically, TrueTech delivers the modules, right? Here you go, GameStop on 1/1, and GameStop says, look, we'll pay you $1,056 on 12/31. How do you account for this? Right, so on 1/1, right, over here, we're going to do the following journal entry, right? Debit note receivable for 1,056, right? That's what they're going to pay us at the end. Credit discount on note receivable. Credit revenue for 960, right? Then what do we do over here on 12/31 when we get the cash? Right, we'll debit cash 1,056, what they tell us, get rid of that discount that we teed up, recognize the revenue on the interest revenue, right? We're treating it because the time value of money of 96, get rid of that note receivable, right? The combo of these two is going to get us to the 1056. Okay, and then finally here, right, this payments by the seller to the customer. You can read that. Not really too concerned here. This is like whenever you would have, it's almost like the reverse setup. You're the business and you're paying the customer. Don't worry about that for the exam, but it is sort of something that comes into play for step 3 there. So we're about halfway through the slides. I'm going to end the PowerPoint video here for the first half of it. We'll see you in the second one.